Well, good morning, everyone, and welcome to the Pulse. I'm Francine Lacqua here in London. So European stocks, as we were saying, dropping, prolonging this volatility on global markets as investors turn their focus to U.S. jobs data due later today. And let's bring in Sophie Huynh, senior cross-asset strategist at BNP Paribas Asset Management, and, of course, our Noor Al-Ali, MLive strategist. So thank you both for joining us. Noor, what a week. We've made it to Thursday. I don't know how much more traders can take of this. I mean, it's just all over the place.
Yeah, and they are looking for reasons to panic, Francine. And I think when you think about it that way, you'll understand why potentially maybe the bottom isn't here yet, right? We've got jobless data later today. That's a massive risk event. You know, the auction for the 10-year yesterday, also the demand was quite weak. It's just not the kind of dynamic that's going to see those buy dippers, you know, coming back to the market. So I'm not too optimistic this morning.
Sophie, what are you seeing out there?
I think it's could be an opportunity to buy on dips, especially on cheap assets. I think we got a perfect storm a couple of days ago. Market illiquidity during the summer, no to soft landing price to perfection, a couple of very crowded trades. Now, I think there's been an exaggeration. We're nowhere near a recession yet. So having a more balanced portfolio and tilting towards like some cheap value assets makes sense.
So what do those look like? And again, I think we had JP Morgan saying, look, about 80% of the carry trade has been unwound.
Yeah.
What more is there?
I think it's not how much left, but it's how orderly it's going to be. I think going forward, we're going to have a much more orderly unwind of the carry trade. I don't think we should continue to pile into it if you want to take a bit more risk. It's better to focus into, for example, shorting the dollar, being long the NOK versus sterling, you know, the cheap value risk tilt you want from there.
And I guess, Noor, I mean, Monday was ugly, right? That's probably the understatement of the year. But a lot of the focus was on AI stocks. It was on Warren Buffett. What he was saying is, of course, that jobs report from the U.S., but it was also the carry trade, BOJ, and earnings. What's the panic or the concern about right now? Is it mainly U.S. focused, which is why those jobs numbers are so important today?
Look, Francine, two opinions make a market, right? Sophie sees an opportunity to buy the dip. I think maybe we're not at a bottom yet. But you do see that a lot of the rotations that we've seen, so into the overnight action, you know, turnaround Tuesday was something that a lot of people was hoping that would carry through. And actually, TV's Markets head Dan Curtis had a great point yesterday where he said the gains that we saw on turnaround Tuesday were actually funded by real estate stocks, by financials. So those are the kind of sectors that show you, well, maybe potentially those concerns over the economy are a little bit overblown. We do know that the economy is potentially slowing. After all, that's what interest rates do, right? You tighten so much that you hope that demand is subdued to the point that inflation does ultimately go back to target. The question here now is the Fed and the BOJ and the RBA as well earlier, which actually said, you know, we're considering raising rates now. It's not even a question of that. But markets have continuously, I would say, bullied central banks, as John authors say, because they have aggressively bet against what policymakers have said time and time again. And a lot of these traders have found themselves on the wrong side of the trade because central banks have just gone the opposite directions. Now, for the RBA's example, for instance, RBA says, look, we might even raise rates, but markets are actually betting that the next move is down, and they're expecting that we'll potentially get a cut from them in December. That divergence creates a lot of opportunities in the markets, and that's where you would come in and find those pockets of value in the market. But so far right now, that global story of an economic slowdown, particularly from the U.S., while China is also struggling, is a big concern. And in this dynamic, I don't see those gains holding through.
Yeah, bullying is a strong word. I mean, I feel like central banks have been very tentative because they also have skin in the game because it's all about their reputation. Sophie, when you look at some of the other things, of course, you know, equities versus bonds, actually they behaved in the correct way. Some could argue this week. Where do you see opportunities? I mean, is it geographically or is it really cross assets?
So I think, so what you said about equity and bonds, the fact that we're going to get into a more negative equity bond correlation basically give opportunities to add a little more risk in the portfolio. Where we see opportunities, Chinese equities, I think the expectations are so low. They are boosting consumption. They are like, even what you saw over the past week, they outperform other markets. So at a time where, as you said, global central banks are going to start their easing cycle, investors are going to start looking for cheap, long-duration exposure. and Chinese equities are one of them.
So how do you play Chinese equities, like actual in China, or do you go for some of the big companies in Europe with a lot of exposure to China?
The problem with European equities at this point is they are a bit more expensive than Chinese equities. I think where the expectations are very low is more on the Chinese side. Mm-hmm. What could be supportive for both Europe and Chinese equities, though, could be the restocking cycle, as well as front-loaded orders ahead of the tariffs.
What do you do with BOJ right now? The million-dollar question, or?
I mean, it really is very interesting, right? They raised rates, and then come Tuesday after the market meltdown, the deputy governor came out and said, well, hold on, if there is such a rout in the markets as we've seen on Monday, maybe we won't, policy is actually not going to be it'll still be accommodative. We won't be tightening in the pace that markets have suddenly reacted to. And I think it's quite interesting, right? I mean, the last decade in Japan is quite interesting. Dealing with deflation is so much harder than dealing with inflation. And now Japan is dealing with a completely different thing than what its policymakers are used to. It's a completely different dynamic. And so I would say that even policymakers themselves need to have that time to assess all the economic data that's coming out and to also see how their economy, particularly Japan and its appeal, the Japanese currency is basically like the world's third largest or most traded currency as well. So there's that global exposure in Japan that's really weighing there. And so I would say that maybe time is the best answer, but traders don't look to be looking to wait.
Yeah, I mean, we talked a lot about Warren Buffett and the fact that he's, taken stuff out of Apple and gone to cash. And we have a story today saying, look, if you look at Berkshire, it has large stakes in 5 Japanese trading houses. They've lost so much that it could present another opportunity. Do you like Japanese equities?
I see dollar yen at 130 at some point. And Japanese equities, I think it's maybe time to shift into small caps versus large cap because they're going to be less exposed to the currency exposure. Mm-hmm. I think the Japanese story is still there. The corporate governance reform is still ongoing. Now it's more trying to navigate what's going on outside of Japan versus like the idiosyncratic fundamental story in Japan, which is still solid.
I mean, the other big conversation this week is, does the Fed have an emergency meeting? Do they cut even this week? Some saying, well, this would cause panic. But I see a lot of the big banks, of course, now raising their risk of a recession. Yeah. I think JP Morgan was the last one at like 35%. Yeah. What's your take on what the U.S. economy does?
I think it makes sense to price a bit more recession priority. We shifted from no lending, soft lending, at this point, having a bit more tail risk into your baseline scenario makes total sense. I don't think we're on the verge of recession yet. If you look at the OECD leading indicator, we're currently in expansion. The next phase is slowdown. Jumping into recession right now on one data point is a bit overstretched, I think.
I mean, 35% chance is high.
Yeah, it's very high, right? And look, the thing about a recession is when it happens suddenly and it happens fast. And a lot of the data that we currently have or the measures that we look at economically is pretty much lagging data, right? Like, so you need to look at a basket case of readings and several readings, as Sophie points out, to see whether or not the economy is stalling. But look, Francine, the pandemic, the AI rally, the boom, there's just so much that's changed in the economy since 2020 that it's been an incredible stretch of run, especially for the U.S. economy, which has held up against a lot of the uncertainties that's been thrown at it. So a little bit of easing or cooling is to be expected. The Fed has had its most aggressive tightening cycle since the 1980s. Inflation is still above target. Services, wages inflation. Home buyers are really now starting to feel that pinch. Demand in the U.S. for the housing market is still quite low and subdued just because of how the mortgage market is set there. So I see a bit of easing to go in. How far that recession goes depends on whether or not the Fed is perceived to be behind the curve or not, right? And so that's really important. Right now, the markets think, yes, they are, right? Yeah. If you look at market bets of where the Fed is expected to go with its policy towards by December, we're seeing about 100 basis points of cuts. Yeah. So that's either 250 basis points cuts or 225s and then 150. That's a big step up in expectations versus just months ago when we thought maybe September's in play, potentially November. Now, though, I'm really excited about Jackson Hole.
I'm excited about Jackson Hole. Something always comes out of Jackson Hole quite big, and then I do feel like market expectations have been, frankly, all over the place for the last 18 months on Fed. Sophie Huynh from BNP Paribas Asset Management and Noor Al-Ali, MLive strategist, both stay with us. Now, coming up, European gas futures jump on reports that Ukraine has seized a gas transit point just inside Russia. We'll look at how prepared the region is for supply shocks. This is Bloomberg. Welcome back, everyone. Now, still with us, Sophie Huynh, Senior Cross-Asset Strategy at BNP Paribas Asset Management, and Noor Al-Ali, MLive strategist. So thank you both for sticking with us. Noor, we talked a lot about the Fed expectations. How does that translate into BOE?
Well, look, the BOE just cut rates. The Fed didn't. So we're off to a great start when it comes to the easing cycle for the Bank of England. The BOE looks to be, or at least the markets are expecting them to adopt a much closer pace of easing to the ECB's, which is a cut, pause, and potentially cut again. So we are expecting that the Bank of England potentially cuts again, maybe once or twice more by December. We're still not in full consideration there, but in terms of the UK, inflation is at target. We've got a new government. The stocks are still undervalued there, so there's a lot of room for them to gain. But when it comes to bonds here, I think maybe they won't really beat treasuries, because if we're expecting the Fed to cut a lot more, I expect that potentially the bond market moves to adopt a similar, slower pace of returning back to their average that we've seen in the past couple of years.
So do you think the Fed cuts a lot more? It has to cut a lot more? Or, again, it seems that a lot of the data points are all over the place in the U.S.
I think we need a further unwind of U.S. exceptionalism that is still embedded into U.S. asset prices. If the Fed were to cut at a faster pace and come to neutral, so the Fed is expected to go to neutral around end of this year, January, around 3%. If the cutting pace is going to go faster, I think it's possible, but on that side, I think it's the major trade we want to put on is a short dollar.
What does that mean for ECB? I mean, again, I feel like there's this gravitational push from the Fed that every central bank is pushing back against that, but it must make a difference.
So it's very interesting, because if you look at the 3 or 1 year forward rates, the ECB is already allowed to decouple from the US to settle at 2, which is not the case for other central banks with the Fed. They might follow and cut at the same pace.
All right, thank you both for joining us. Sophie Huynh there from BNP Paribas Asset Management, and Noor Al-Ali, our MLive strategist. Now, European gas prices have surged to the highest level this year following a report that Ukrainian troops have seized a key gas transit point near the border in Russia. Meanwhile, oil has also had a recovery rally after its sell-off at the end of last week. Now we're joined by Amrita, founder and director of research at Energy Aspects. Amrita, thank you so much for joining us. I've been dying to talk to you all week on this macro meltdown, and actually, if you look at some of the forces influencing oil prices, where do we go from here at a time where, again, macroeconomics is very uncertain?
Yeah, absolutely. And, thanks for having me. I was looking forward to this as well. So, look, I think oil's very much been swayed by the macro factors right now. But I think in the grand scheme of things, if you look at some of the other market corrections, oil's really held its own. And that's partly because oil's own fundamentals are stable. Stocks are drawing. That's exactly what should happen this time of the year. Over 1 million barrels per day of draws, kind of June, July. It's slowing down a little bit now because of refinery outages, but generally speaking, it has been drawing quite substantially. Also demand. I mean, if you look at some of the revisions made by the EIA for April, May, I mean, these are huge upward revisions, particularly to U.S. gasoline demand. Doesn't show us that things are falling out of bed at all. Yes, there are pockets of weakness, China being one of them, but overall, pure oil market fundamentals are okay. It's just much more a sentiment-driven sell-off, and oil, of course, is a part of that. That's why we're below $80 for crude. But I'm not expecting a meltdown like some of the other asset classes we've seen.
Yeah. But, Amrita, again, I guess the market is on edge over this possible retaliatory strike by Iran on Israel as payback for some of the assassinations of the Hezbollah and Hamas leaders. We've been waiting for that. Is the market going to be tight until we get something?
Yeah, and I think that's a very fair question, that how much of this kind of quote-unquote geopolitical risk premium is in the price. Is that why crude hasn't fallen further? I don't think there's a lot in there. There's definitely, lots of chatter, lots of rumors around imminent retaliation. And to your point, hasn't happened yet. There are some headlines and warnings it could happen today, or at least kind of today or tomorrow. I think, yes, the market is expecting that. But at the same time, nobody is really expecting a big outage to oil facilities. Of course, miscalculation risks are high, and Israel has in the past kind of attacked Iran's oil depots just as a warning shot that, look, we can if we wanted to attack your infrastructure. I think everybody is trying not to get there. Those risks are there, but that's not the base case for us or for most people. So I think I actually don't think right now there's a lot of geopolitical risk premium in the price. If anything, Libya, and we've seen a force majeure yesterday on one of the big 300,000 barrels per day field, that's probably a bigger focus for crude in particular, because, again, that's much more of a Brent crude equivalent and has been supporting time spreads.
Amrita, we were also seeing the possibility of this hurricane-related disruptions in the U.S. especially. So what does that mean? Could we see oil in the mid-80s?
I absolutely think that late summer we have been talking about a rally. We're holding that view, and that's still the case. Hurricanes can act both ways, right? If you lose refineries, that could mean less crude demand. But of course, we lose products as well. So you do get, gasoline and diesel prices going up. But if you lose production and ports, then yes, it does support crude prices. In general, we had a very early hurricane. And if, again, we get an increase in hurricanes, then we are expecting to lose barrels overall, whether it's crude or products. And that does tighten up the balance. So there are those risks, right? Weather factors, Libya, geopol generally, those will kind of keep the market or keep people from shorting crude significantly.
But overall, so you see this balance of supply and demand remaining healthy, right? I guess for maybe apart from a bit of weakness from China, the rest seems pretty much balanced. Is that fair?
I think it's balanced. Healthy is a relative term. We're not saying that, we are screaming bullish and we've run out of crude stocks, but it is healthy in the sense we are drawing. That's exactly what is to be expected. I think right now the focus for everybody, oil traders, analysts, it's that 2-year treasury yield, right? Like that's a signal of what is the Fed going to do. Our macro guys have maintained for a long time that it's going to be 2 rate cuts. We are now expecting 3, but it's still 25 basis points, right? Because for us, we are saying this is an orderly slowdown. We've been expecting this slowdown. The oil markets have been signaling this slowdown for a lot longer than equity markets have been. So we've been warning about this, but it's also not a macro meltdown. There are very specific factors that's distorting the U.S. macro data, Beryl being one of them, the IT outages being another factor. So I think the market's in a bit more of a panic mode. Again, not saying demand is growing by 2 million barrels per day. It's more like 1 million, but equally, it is not contracting. So I think there just needs to be a bit more, a bit less panic and a bit more calm, and then people will realize that things are pretty stable for oil.
Amrita, what's your take on gas? So again, these European natural gas prices have resuming gains, which is frankly a nightmare for some of the central bankers, yes. Not only Bank of England, but of course the ECB. And this is on, they're trying to monitor the transit of Russian fuel across Ukraine.
Yes, absolutely. And we kind of highlighted and put out a note yesterday on this very factor. And look, generally speaking, European gas is pretty well supplied. And yes, this outage, of course, adds to that. And again, both for crude and for gas, the market has been quite short. And that's why you kind of see the outsized moves that you see on a daily basis because of that. But it's not like 2022. Or even kind of 21, when we had that acute shortage. There is ample gas in storage. So it's not that we are expecting a kind of tripling of prices from here. We've seen the move up. And yes, of course, that does put, basically gas has to go up to kind of cold switching levels. Otherwise, that's the only way to balance the market.
But Amrita, right now, again, this natural gas flows via Ukraine are continuing. What happens if this ever stops?
What happens if it doesn't stop?
If it stops, is that your question? So we're looking at the station near the border. If this is disrupted, what happens to the price of gas?
So I think, look, of course it's going to go up, but again, we have so much storage for Europe right now. And remember, we've lost about 15% of industrial production for good in Europe, both industrial and residential as well, some through efficiency gains, some through just losing industry to the US because of IRA there, and just generally very high gas prices. That's how Europe has balanced. So demand just isn't that high right now, and that's why the amount of gas we have in storage has been enough, and that's why prices haven't gone up as much. Yes, there is some upside risk, but that's why I'm saying I don't think the risk is nearly as much as what we had in the past, like 2022, just because demand is outright lower.
So interesting. Amrita, thank you so much for joining us. Amrita Sender, founder and director of research at Energy Aspects. Now to some other stories making news, and Disney has reported mixed third-quarter results with weakness at its theme parks offsetting its first-ever profit in streaming. Now Disney sees pressure on park attendance lingering for the next few quarters after previously predicting a rebound in the final months of 2024. And Warner Brothers Discovery shares tumbled in late trading after second quarter results that missed expectations. The parent of CNN posted a charge of $9.1 billion after writing down the value of its traditional TV networks. Now, the firm has concluded that cable channels are no longer worth what they were in 2022 when Discovery acquired Warner Media. Cathie Wood has scooped up shares of tech firms caught in Monday's market rout, just as her flagship fund actually sank to a new low for the year. Now, Wood's ARK Innovation ETF bought Amazon, chip maker AMD, and streaming device maker Roku, amongst others. While ARK closed Wednesday at the lowest levels since November, down more than 20% this year. Now, a couple of the things that we're watching out for: Siemens shares also struggling for direction after a weak second quarter for the German industrial firm's factory automation business was balanced by a jump in software demand. I'm also looking at Zurich Insurance posting a 7% gain in profit for the first half of the year that actually beat estimates as it increased revenue from its life segment business, while Munich Re is actually reporting net income for the second quarter that beat estimates. Now, coming up, shares rallying in the FTSE insurance firm Beazley after a profit beat. So we discuss everything from climate risk to cybersecurity with the company's chief executive, Adrian Cox. That's coming up next, and this is Bloomberg. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. European stocks slip as volatility grips global markets. Weak demand for treasuries weigh on sentiment in the U.S. Well, JP Morgan says there's an increased chance of a U.S. recession this year, this as it estimates 3/4 of the global carry trade has now unwound. And in the UK, anti-racism protesters turn out, and there are thousands to counter far-right demonstrations that failed to materialize as Britain probes possible foreign government involvement inciting violence online. Well, shares in Lloyd's of London insurance company Beazley are rallying this morning after it reported pre-tax profit for the first half of the year well ahead of estimates. Now, the FTSE 100 firm is navigating a series of threats, including climate change, geopolitics and cyber risk following the high-profile outages at Microsoft and CrowdStrike. So let's discuss all of this with Adrian Cox, the chief executive of Beazley. Adrian, welcome to The Pulse. Thank you so much for joining us. So you have a strong set of results. There's just a lot going on in your industry between, catastrophe-related claims, between what's happening with cybersecurity. What do you worry about the most in the next 12 months?
I think we're living in an era of accelerated risk and an elevated risk, and there are lots of things to think about. In contrast with a few years ago, the performance that we've managed to generate this half year is against the backdrop of there's a lot of stuff going on, and we have to worry about it all, I think. The CrowdStrike outage was very interesting. No. I know people have been waiting for a while for such a thing to manifest, to see what it would look like, and it has. And I think, fortunately, businesses recovered fairly quickly, and insurers did their job. So I think the answer is lots of things rather than just the one.
What can you learn from what happened with Microsoft and CrowdStrike?
I think it's a very interesting data point. On the one hand, you can see the impact that an error in one company can have across the world. I think on the other hand, you can see how quickly that impact can be mitigated. The error was identified fast. The fix was put out relatively quickly, and most companies got back after a day or two. So I think it shows the potential, but also the potential to fix things quite quickly, and that's quite useful. I think had it been a cyber attack, it would have been a much bigger issue.
And can you talk us, when you look at some of the projections for catastrophe-related claims in the second half of the year and into next year, is an increase a new norm?
Yes, I think we've been seeing an increase in the level of catastrophe activity for a number of years now, and not just the sort of traditional catastrophes of hurricanes and earthquakes, but also other things like severe convective storms, flooding, wildfires, and so on and so forth. And I do think we can expect to see a continued incidence of them in both where you expect them and also in new areas. Yeah. And that's something that we have to figure out and cope with and price and build resilience for.
Yeah, so how do you do that? Again, are you setting aside provisions for the increase in some of these claims? Do you have to do new products? Like, what does it look like 2-3 years from now?
Yeah, so I think when you're looking at natural catastrophe risk, you have to have a forward-looking view of risk, because things aren't behaving as they used to, and you need to think about that. But I think, and so yes, we need to provision for it and to price for it. But ultimately, I think it's a case of building more resilience against it. So thinking about how you build and protect assets so that despite this increased incidence of natural catastrophe activity, assets remain intact. No. That's the ultimate answer.
How do cyber attacks change your business? Do you need to rely a lot more on consultants and advisors to try and understand the threats out there?
Yeah, so we work with a lot of companies and governments around the world to monitor and figure out how to mitigate new threats. We've also got quite a big ecosystem in-house that kind of allows us to do that. Underwriting cyber is a live thing. New threats emerge constantly. But I think, it really shows the value of insurance, because we can understand this stuff. We can help our clients understand this stuff and protect against it. And it's a key risk for businesses.
But is it going to get harder with AI? Again, I know there's like worst case scenario, there's best case scenario. I mean, some of this stuff, frankly, is like nightmarish. How quickly do some of these threats get worse?
I think these threats change all the time. AI is both an opportunity and a risk. It's an offense and it's a defensive tool. And actually, we're finding it is as useful for defense as it is for offense at the moment. I think AI has helped some attacks get more automated and more scalable, but we can figure out how to protect against that. And so, as with all things technology, it can be used, for good and for crime. And it's just another thing that we have to think about.
Are you also rolling out more catastrophe bonds, I guess, tied to cyber?
Yeah, so we launched 2 this year. I think it's an extremely useful tool for us. We will consider continue to work with the ILS markets to do more of that. I think as cyber demand grows and therefore the amount of business we write grows, we have to figure out how to hedge it properly. And the catastrophe bonds are a useful way to do that. And there's lots of investor appetite to do it. The ILS industry traditionally has been concentrated on natural catastrophe risk, and cyber diversifies against that. So it's a useful new investment for those capital markets to do.
And so how much more? Is it difficult to quantify with these rising premiums of how much of this type of product you will offer?
I think there's so the ILS market for cyber is several $100 million now. It's a fraction of the size of the natural catastrophe ILS market, but I think it has the potential to be the same size. So, we're sponsoring bonds. Other insurance companies are doing the same thing, and I think it's a market that should grow quite quickly, and that's very exciting.
I know that our viewers just want to know more about what kind of threats they're faced with. How much do you have a breakdown of how many of these cyber threats come from state actors? And how much are they from actually, people doing it for business?
The vast majority of cyber attacks are for criminal purposes, i.e. for making money. Yeah. And that accounts for the vast majority of what we see. I think the really big potential events are more driven by nation states, because they're the ones with the capability and the resources to be able to do that. And those are the ones that are more politically motivated. I think the consequences of a nation state doing such a thing are quite big, and therefore they're relatively rare.
And we talk a lot about, again, AI being able to replicate voices and things like that. Is there a use for AI in trying to protect against cyber attacks?
Absolutely.
What does that look like? Absolutely.
And, we're seeing government agencies and others start to do that. As I say, I think they're actually more useful for defence at the moment, and that's a good thing.
Adrian, thank you so much for joining us. What a fascinating conversation.
Thank you.
It's a complex world out there.
Yes, it is. Yes, it is.
Adrian Cox, our Chief Executive of Beazley. Coming up, anti-racism protesters turn out in their thousands to counter far-right gatherings that failed to materialize. The latest on the UK unrest is next, and this is Bloomberg. Let's turn our attention to the U.S. election now, where Vice President Kamala Harris and her new running mate, Tim Walz, continued their tour of key battleground states. Yesterday, they held rallies in Eau Claire, Wisconsin, and Detroit as they looked to turn on the charm to voters in swing states. Well, let's speak to Bloomberg's Bill Ferries, who's been covering this very closely. Bill, thank you for joining us. So how are the Democrats organizing themselves, and how are they doing in the polls?
Well, the Democrats' big goal right now is to really get Tim Walz out there, help define him, try to keep this momentum going from Kamala Harris's first really 10 days as the candidate for the Democrats, heading into the Democratic convention, which is the week after next. But Walz just announced as a vice presidential candidate, and so they're hitting the road trying to campaign in those critical battleground states. We've seen them in Wisconsin and Michigan, as you mentioned. They're going to continue on to places like Nevada and Arizona in the coming days, really trying to get in front of the voters who are going to decide this election.
So how's the Trump campaign actually fighting back, and where do they go next?
Well, it's interesting. What we saw over the last day or so was the Vance campaign kind of trading places with the Harris-Walz campaign. J.D. Vance was in both Michigan and Wisconsin, just like Kamala Harris and her running mate were. We have not seen Donald Trump on the road this week. He will make an appearance Friday in Montana, which is a very Republican state. It's surprised some people that he hasn't been out there a little bit more, punching back directly in front of his supporters, but that may still come in the days ahead. They are really trying to also define Tim Walz as someone who is too progressive for America, who doesn't share the values of who they think the majority are. So far, the momentum seems to be on Harris's side. She has wiped out the lead that Donald Trump had in most polls before she became the nominee, and has obviously closed the money gap, as we've been reporting over the past week. There's still about, I think, 89 days to go now before the election, so I think there will be ups and downs from both campaigns in the weeks and months ahead.
Bill, thank you so much. Bill Ferries, of course, almost on the campaign trail for us, and we'll have plenty more throughout the day. We have a video also of J.D. Vance, very close to Air Force Two, and we talk merchandise. Now, thousands of anti-racism protesters rallied across the UK last night following more than a week of rioting by far-right groups. Now, misinformation on social media helped to fuel the days of unrest. Elon Musk was criticized after suggesting on X that the riots were due to mass migration, adding that, quote, civil war was inevitable. Let's bring in Rosalind Matheson, our EMEA news director, and also Parmi Olsen, our Bloomberg opinion columnist, who specifically has been talking about the riots and tech. So thank you both for joining us. Roz, yesterday there was a lot of police, out there across the UK getting ready for more far-right protesters. That didn't materialize. We actually had the opposite. It was anti-racism protesters that were out in force.
Well, that's right. So we're all prepared for these far-right groups to gather in these different sites around the country, mostly outside London. We knew there was going to be a big police presence there. They were warned about that. But in fact, the numbers that turned out were the counter-protesters, the anti-racism protesters, really fanning out to these places in numbers, ready in case these people turned out. And they didn't in the end. There were a few scattered gatherings. There was a bit of scuffling that went on. Some arrests were made, but nothing like the level of the riots and the violence that we saw over the past week. And, a clear message was sent to them from the government, from the police, that they are going to face arrest, they are going to face court and possibly jail. And that's going to be done very, very quickly. So quite a strong message there. The question is, they didn't come out last night, but are they gone?
Yeah, and Parmi, I guess the other question is, of course, who do we know? This is based on misinformation. This is not something that's happened in the past in protest, actually against the cost of living or some, a policy on immigration. Who do we know is behind some of this misinformation?
Well, it's been traced back to a news story on a site called Channel 3 Now, very soon after the Southport attack. This news site named the attacker as a Muslim asylum seeker. That could have been the end of the story. The problem is that people shared that story on X. They shared screenshots of it, and it went completely viral on X. Since X, formerly known as Twitter, was bought by Elon Musk, the trust and safety team of that platform has been gutted. Much lighter content moderation on misinformation. And so that's why this story was just allowed to spread. And you had online influencers like Andrew Tate, went on to tell his more than 9 million followers that the attacker was an illegal immigrant. That ended up being picked up by Nigel Farage, who was saying similar things in TV interviews and kind of making similar suggestions. He later said that he got that information from people like Andrew Tate on Twitter. So it's actually had a massive impact, the spread of this misinformation on social media, and X in particular. And then separately on another platform called Telegram, it's a messaging and broadcasting app. That's where you saw not only misinformation, but also calls to violence. I saw some posts that said, Wednesday night, mask up, no more immigration. They won't stop coming till you tell them. This is in a channel of 13,000 people. That was meant to be for last night, for Wednesday night, which didn't happen, of course, because the anti-racist protesters came up much more in force. But previous to that, over the past week, I don't think people were really aware that these kind of calls to violence were spreading around platforms like Telegram and to some extent TikTok as well.
Rosa, is this also, we're 1 month into the new government under Keir Starmer. Immigration wasn't really part of his platform, immigration policy. So is this also to test the new government or to send a clear message?
Well, quite possibly it's a bit of everything. So we do have that new administration after the Tories were in power for a long time. Perhaps these groups want to cause a bit of mischief for Keir Starmer and his new administration. It's a big challenge for him because he came in saying, I want to focus on the economy, we've got a budget, we're going to have policy. Instead, he's dealing with some really fundamental questions for British society. And so there's that aspect of it. But, also it's just riffing off the horrible events of Southport, that disinformation and fanning thing that we've seen go on. And that's really something you can trace back to years of conversation and debate and tension in the UK over migration, related to the Brexit decision and so on. It's never really gone away. And even if these riots do stop again, fundamentally, you still have these issues where people feel quite strongly about migration. A lot of people feel that it's being dragged into a poisonous debate around race, religion and so on. And so how do you deal with that? And that's the broader question for Keir Starmer also.
Yeah, and how do, some of the platforms address it? And one of the questions that we've been trying to figure out is actually if Elon Musk tweets something on X that says the UK on the rest of civil war, is there anyone to stop him saying that?
Well, exactly. And I think to your question about the platforms, it's very different how they deal with this sort of thing. I think Google actually does a pretty good job with kind of keeping an eye on the spread of misinformation on YouTube. X does not. And part of the problem, I think, for Keir Starmer as well is he's inherited a law that was put together by the Conservatives, which was actually very ambitious in its scope to address online safety and, in particular, calls to violence and misinformation. The problem was, just before it passed, a key part of the law that addressed legal but harmful material, which would have encompassed misinformation like we've seen over the past week, got taken out. And so now regulators here like Ofcom cannot go to the likes of X and say, you've broken rules, because actually they haven't broken rules. There are no rules about misinformation. They were very cleverly designed for this act to try and thread the needle of free speech. They were based on health and safety law, but unfortunately that got watered down. So I think Keir Starmer is in a very tricky position now because he had this law that he could the Ofcom could use to address these issues. That's been watered down. And now he's dealing with Elon Musk, who's effectively an internet troll. The saying goes, don't feed the troll. And so Starmer has to also make sure he doesn't get drawn into a war of words with this billionaire who has been fanning the flames on his own platform and just causing a lot of trouble.
And Roz, then, of course, in Austria, so Taylor Swift has cancelled 3 concerts in Vienna after authorities there said they had uncovered an Islamist terror plot to attack some of the fans in the city. What does that, this is a threat that's coming back.
Well, that's right. So what we know is that they've arrested 2 people, including a 19-year-old. They say that the 19-year-old seems to have been radicalised by ISIS. We don't know a lot about that. There are reports that perhaps a 3rd person has been arrested. They seem to have been considering a bunch of potential targets in Vienna, including the Taylor Swift concerts, which have now been cancelled. We don't have a lot of detail about how advanced those plans were these 3 acting as a small group. We don't have a lot of detail, but it does come into that environment again, like Austria also, like many countries in Europe, is facing those conversations around immigration, race and religion, and struggling with them. And how do you deal with the fact we've got a lot of migration coming from different parts of the world into Europe, people who are fleeing desperate circumstances, but that creates, debates and conversations in the countries they come to. And, again, disinformation may have played a role in what we've seen in Austria, but we are expecting more details about that, potentially from a briefing with the prosecutors in Vienna in a couple of hours.
Roz, thank you so much, Rosalind Matheson, Bloomberg's EMEA News Director, and thank you also, Parmi Olsen, Bloomberg opinion columnist. Now, coming up, weapons and ammunition manufacturer Rheinmetall beats first-half sales estimates. We discuss what that tells us about Europe's defense sector. That's next, and this is Bloomberg. Well, German defense manufacturer Rheinmetall has beat estimates for the first half of the year, reporting better than expected weapons and ammunition sales. Let's get more with Bloomberg's Laura Alves, who's in Frankfurt. Laura, good morning. So how did Rheinmetall fare in the second quarter, and what does it actually tell us about defense in Europe?
So Rheinmetall had another very exceptional quarter in this second quarter. What is happening to them, the CEO has described as an accelerating super cycle. He says that they've never seen that kind of growth before. The company's profits doubled, they increased sales by half, so this really tells us that the European defense ramp-up is very much still ongoing. And the company is also seeing sales of around 10 billion euros this year, which is very much unheard of for a German defense contractor so far. And in addition to that, with Rheinmetall, all eyes are on backlog as well, where they currently have over 48 billion euros in backlog, which is another new record that they set. And this is set to increase to 60 to 70 billion euros. So you can really see that there is no shortage in orders or interest in the European defense space at the moment.
So, Laura, one of the craziest stories was, of course, the assassination plot against the company's CEO. What does it tell us about them being targets?
So basically, with this assassination plot, it was a Russian plot, and the US and German security forces uncovered this and foiled the plot. And this really shows that not only are individual companies, but also individual people, in this case, very much in focus in a way that is unprecedented. This plot involved other defense chiefs as well, not just Pappberger, but he was a target that was, his plot was the most mature one out of all of them. And this really shows us that this is another facet of this hybrid warfare that Russia is waging at the moment with cyber attacks, espionage, and so on and so forth. So the situation is being closely monitored at all times, obviously, but it definitely remains tense.
Laura, thanks so much. Laura Alves there with the very latest on Rheinmetall. Now, this is a picture for European stocks dropping. We've had a week. It's been a week and a half, but it's only actually been 4 trading days. So European stocks are dropping, prolonging this volatility that has really gripped global markets, I would say, over the last 4 days. Again, this is as the debate around central bank policy decisions continue to fuel this investor anxiety. Today, we have U.S. jobless claim figures. They're definitely in sharper focus than ever after last week. week's flimsy payroll numbers, and then investors also bracing for U.S. and Japanese central banks to potentially move interest rates in opposite direction in the coming months. Up next, a Bloomberg Brief with Manus Cranny in New York, and this is Bloomberg.